1. A trade-off theory. The first statement of the theory was provided by Krauss and Lichtenberger, 1973, and states that optimal leverage reflects a trade-off between tax benefits of debt and bankruptcy costs. According to these authors, expansion in leverage increases the probability of bankruptcy and thus increase expected bankruptcy costs. There is a need enough debt to get the tax benefit but not too much to suffer financial distress costs. To explain this, there are many benefits if the company has reached the optimal capital structure. In fact, the cost of debt is cheaper than the cost of equity. Any increase in debt until this optimum level lead to decrease the cost of capital, benefit from tax shield and increases the firm value and so on. Any increase more than optimum level will result in higher financial risk which requires higher returns to shareholders to compensate the risk. Also, the cost of capital will rise, and the value of company falls due to financial distress. 2. Pecking order theory. It was first suggested by Donaldson in 1961 and it was modified by Myers and others in 1984. The choice of the capital structure reflects the tendency of firms to prefer financing new projects with internal funds and issuing debt rather than equity when external financing is necessary. The tendency to avoid external finance is motivated by management's desire to avoid the scrutiny of capital markets and the costs related to information asymmetry. Management is concerned that the issuance of debt will draw attention to the firm's financial strength and may cause a revaluation of its credit rating. Equity is thought to be especially sensitive to information asymmetries since the market knows that a firm is unlikely to issue equity if it believes its stock to be undervalued. The market thus views the issuance of equity as a signal that the stock is overvalued, and responds by driving the stock price down. There are important conceptual differences between pecking order theory and trade-off theory. While trade-off theory states a positive relationship between profitability and debt ratio, pecking order theory considers that more profitable firms use less debt. 3. The market timing theory was first introduced by Baker and Wergler, 2002. This theory suggests that managers are able to identify certain time periods during which equity issuance is less costly due to the high valuation of companies' stock, which leads to minimize the cost of capital. In addition, this theory suggests that the manager's ability to time the equity market affects the firm's security issuance decision and ultimately the capital structure of that firm. Baker and Wergler suggested that firms issue securities depending on the relative costs, so, if the cost of equity is low relative to the cost of debt, the firms are more likely to issue equity. Accordingly, firms are more likely to issue equity when the market values are high and to repurchase it when the market values are low. This results in higher levels of debt when stock prices are relatively low and vice versa.